Welcome to the HVAC Financial Freedom Podcast, a show where we talk about HVAC business ownership and financial freedom by sharing stories and advice of experts who can help you get there. Now your host, John Victoria.
Hello and welcome to the HVAC Financial Freedom Podcast. I'm here as your host, John Victoria, and today we are talking some infinite banking strategies. And so my guests for today are Anthony Faso and Cameron Christiansen, founders of Infinite Wealth Consultants and hosts of the Infinite Wealth Podcast. Anthony and Cameron are passionate about empowering families and business owners to create passive income and build wealth without the risks of Wall Street. And one thing I will share as well is that I have been working very closely with both of them over the past year, and they're just incredible guys. And I'm really excited to bring to you the concept of IBC if you've never heard of it, and also dispel some of the myths with them. So Welcome to the show, both of you.
Thanks, John. Appreciate it, man.
Yeah, we are glad to be here.
Yeah.
And I think this is a first as well. The first time I've had three guests on at the same time. So we are breaking some ground.
All right.
Very cool. Very cool.
Awesome. So I guess just to kick things off, I'd love for everyone to get to know your backgrounds and what you guys are doing before you got into Infinite Wealth and the business you're currently in, because I know both of you have very diverse backgrounds and different. And so could you just talk very briefly on like how you guys came together and what you were doing before this?
Yeah, I'll share a little bit about my background first. Is that, man, I don't know how far back you want me to go, but I moved to Las Vegas 20-something years ago, and originally it was for school. And I actually created a business on the side while I was going to UNLV. And that business started doing pretty well. And so I transitioned over to that full time. And so that is really what led me down that kind of entrepreneurial business owner role, is that I started that and then I started making money, to be honest.
Yeah.
And I'm like, you know what? I go back to school and be making less. So that's really how I got started. And then it was just the typical stuff that business owners experience. And typical stuff such as frustration with, I'm making some money. Why am I paying so much in taxes? I've got some cash that's starting to pile up. What do I do with it? And then here in Las Vegas, the type of business that I had, it was very volatile. The income was. And so, man, there's many months where I had really good months, and there's some months where I made literally zero. Wow. And so that was a huge frustration point for me. And then also just as a business owner, I was frustrated and overwhelmed because there was so much financial advice out there that I had no idea which way to go or how to get through it and figure out what was good or what was best for me. And so I was an entrepreneur looking for solutions, and I came across the infinite banking strategy. And you know what? It absolutely made sense to me. First time I heard it, it clicked with me. It addressed, a large majority, if not all, of the major issues that I had. And so I started implementing it right away. And that is exactly how I got into this business. Is I implemented it for myself, and then I just started sharing the solutions that I found with other people. Go for it.
I'll tell you, I'm born and raised in Las Vegas, joined the Army right out of high school, got a degree in accounting. And really, back in the 80s, I watched the movie Wall Street. And, I kind of, we didn't have a lot of money growing up, so money was always interested to me. And so I always was interested in money, and I wanted to be a stockbroker for the longest time. And I really don't know why I ended up getting a degree in accounting, but I got a degree in accounting, worked for PricewaterhouseCoopers. Then I eventually started my own firm, mainly because I wanted that time freedom because I had young kids, right? And one of the problems I had when I had my own business is when I started that, to be honest, I incurred some debt to get started, right? And then when I started making money, I'm like, okay, I know I need to save for retirement, but I don't want to lock up my money until I'm in my 60s. And I'm a little hesitant to pay off the debt because I may need that money in my business. So to be honest, what I did was I did nothing, right? I didn't pay off the debt. I didn't save, but then somehow that money just kind of trickled away somewhere, walked away. And then I was working closely with my typical financial planner. I mean, so he wanted me to do an IRA. We did the low cost index funds, and I was actually about to get licensed, and we were going to like actively work together. But then 2008 happened, and I saw the devastation that had on my clients. And I told my financial planner, I'm like, I can't do this. I can't tell a client, hey, you did everything right, but to no fault of your own, your 401k is now a 201k. And so that right there opened up my eyes to some new ideas. And I realized that there's a financial crash, or what they say, correction, about every 10 years. You know, Cameron and I even went back to the 1900s. There's a recession every decade, except for this last decade. But I knew if I didn't do anything different, why would I expect a different result? And I realized some of my clients were actually doing very well during this time. So I reached out to them. How are you prepared for this? You know, what are you doing differently? What are you reading? Where are you putting your money? And that's where I got exposed to the book, Becoming Your Own Banker. And also Rich Dad, Poor Dad, which I think most people, right, with Robert Kiyosaki. And so I started doing that for myself, kind of getting my money out of Wall Street, and kind of focus not on building up my net worth, but creating financial freedom, you know, according to what Robert Kiyosaki teaches, where your passive income is more than your monthly expenses. So I started doing this myself. And then some of my clients were like, hey, I don't really trust Wall Street. I'm looking for something different. I'm a business owner. I want to invest in my business, not necessarily Wall Street. So I'm like, hey, this is what I'm doing. And eventually I was able to turn that into a business. But then I had a growing CPA firm and kind of teaching IBC. Oh, yeah. And I also had a family like somewhere way over here. Right. And so I wanted, whatever I decided to do, I wanted to be one of the best. And I figured you can't be the best in two fields. So for me, the choice was very simple, very easy. I sold my CPA firm and started doing infinite banking full time. And then Cameron and I had worked at another firm together. And then I left that and started my own for a while. And I realized, I mean, there's some great opportunity having your own firm, right? But there's also a lot of burden. Like all of that weight is on my shoulders. And, you know, one of my mentors had said, if you want to go fast, go by yourself. But if you want to go far, bring somebody with you. And so Cameron and I were friends from the beginning, and we had same values and the same goals. So we ended up joining forces, which has been great. For one, I don't have as much weight on my shoulders, but it's always great to have some other ideas. And also I can get some great advice on hair care from Cameron. Now that's kind of an inside joke. We do have our own podcast, but I often joke, maybe out of spite, because Cameron's hair is so good, that I always joke that he loves Paul Mitchell. But like, here's an example. Doing it together, we can have fun. Well, I don't know if Cameron's having fun right now, but I'm having a blast making fun of him.
This is the first time I've heard that I'm Anthony's Atlas. I came along and lifted up his world and just saved him from the burden of life.
I never said Atlas, but so now kind of we focus our business strictly on teaching the infinite banking concept, helping people start it, and more importantly, help people execute it. Right. And again, our goal is to help people achieve that financial freedom where their passive income is more than their monthly expenses.
And I would add that there's I would just say that.
I just
go ahead.
So I think my internet connection is this. I just wanted to point out, like, I think it's such a beautiful partnership both of you have built, because I could see that there's common threads in terms of the values that you both have. And so a few things I noticed it's the time freedom. It's, living life on your own terms. It's the fact that since the beginning, like, it was so easy to get along together. And a lot of the mindset around personal growth, development, and freedom, I think you both share. And I think that's you guys have done what a lot of people have not been able to do, right? Build a strong partnership based on a lot of those core values. And I think it's amazing. So I just want to highlight that. Sorry for cutting in.
No, feel free to interrupt Cameron anytime. I do all the time.
No, thanks, John. And I was only going to add that the way that we teach IBC is just purely education based, right? Is there's a lot of misconceptions around IBC out there, and a lot of people are just getting introduced to this idea now. And so, man, we're pretty easy. We're laid back. We're just going to educate you on the pros and the cons of IBC.
Love it. And I think one other key thing that you guys mentioned in your intros is really, part of it was you did self-implementation. So you tried on yourself first, right? I think that's a beautiful thing. And the second thing was you look to see who are the successful people already in your life. And some of those people were clients. Instead of trying to reinvent the wheel, why not be in those same circles? Why not get those same inputs? Why not read those same books? And it sounds like that's been such a transformative effect in terms of your life trajectory and everything that you're doing now, which has led to today. And so I think that's really incredible, all of that. Awesome.
Yeah, absolutely. That mentorship piece, right, is, man, if you want to be successful, somebody's out there doing it better than you, and you got to go find who they are and ask them how they're doing it. And so you got to have a mentor if you want to be successful.
And with that mentality is why Cameron looked out for me, because he was looking for a mentor. And here we are today. It all worked out.
I'm so lucky. I'm so
set that up for me, man.
I teed it up.
You didn't see that coming?
I thought you'd whiff. Yeah.
Awesome, guys. So you guys already mentioned it, but I just want to get it on record again. Like, so how are you guys defining financial freedom? You mentioned Kiyosaki, but just what is your, I guess both of you, like, is it same definition for both of you, or is it same as Kiyosaki's? Like, what is that definition for financial freedom?
I mean, to me, again, we're disciples of Robert Kiyosaki, right? Is creating that passive income now and not waiting and hoping for it to be in the future. So we actually have these shirts. I'm surprised none of us wore. Cameron wanted to wear that pink shirt today, but we kind of, one of our sayings is we have passive income, or your pie is greater than me or your monthly expenses. And that's that is how we define it. We want to create that passive income now. And I think a lot of people hopefully realize that during this recession, maybe their business took a dip, or they got laid off, or, there were some tough times, but to have that income coming in where you weren't actively pursuing, I think it made an example of how important having that passive income is.
Financial freedom, right? To add on to what Anthony's is, we got different perspectives. Is where I'm at in my life is, man, I want a pretty good lifestyle, to be honest, as far as a balance between work and then also family. As my kids are young, my kids are 12, 10, and 8, and they are a priority. I just see this whole thing going faster and faster, and realizing they've got less and less time with them. And so, because I think one of the reasons our business is successful is Anthony and I have very similar approaches when it comes to family. And so, a big priority of financial freedom for me is being able to kind of step away and be able to spend time with them on the weekends and the evenings. And, that's part of it. So you got to have the foundation of that income in place to be able to step away. So, then if you look even farther, and it's that generational piece is, it's cool if you built a nice lifestyle for yourself, but really, our objective and most of our clients' objectives is not only provide for themselves, but make it better and easier for their kids along the way. And so how do you do that? You don't just hand people money. You got to have a conversation. You got to teach them how money works. And so that's that generational piece, not so much money, but Anthony likes to say sense.
I love that. And I forget who said it, but yeah, that generational wealth and passing on those same financial frameworks, mental frameworks of how people spend, how people invest, like that's the tricky part, right? You can create all the wealth in your lifetime, but leave it to the second generation or third generation to potentially potentially lose it all. So it's like not just passing down the wealth, like you said, but it's like passing down that information,
The sense, right?
and those beliefs. Yeah, right. The sense, and to the next generation, which
we're talking about, like where we talked about wealth. It's not just dollars. It's more importantly sense, as in common sense. And particularly with a lot of our clients, they're going to end up leaving a much larger financial legacy than they thought, which if we don't teach that next generation the tools and the financial sense to handle that money, we could be doing more harm than good.
A lot of those statistics that you hear about, the family wealth diminishing from generation to generations, because you've got a business owner, typically a producer, that knew how business worked, right? Knew how to create wealth, but then they failed to teach it to the next generation, and they just got accustomed to having stuff handed to them. Mm-hmm. And that is not a recipe for success at all. So
man, that's the magic formula. It's like, how do you pass that on? I love that. And so I guess transitioning now. So we talked about financial freedom. Now I want to talk about, the infinite banking concept and becoming your own banker. And before we explain it, I was wondering if you could maybe talk about what are some of the issues that you guys faced or that you see that it solves, right? So in the beginning, like you mentioned, that there were some issues. Like, what are some of those pain points that someone might be experiencing by investing in some of the traditional vehicles that, is normally out there?
Ooh, okay. You teed that one up, John. Okay. So for a lot of it, to me, the biggest opportunity, the biggest advantage of incorporating this is the access to your money. Like I had mentioned in 2008, most of the times people's wealth was stored in their 401k or IRA and the equity in their home. Both of those took a huge hit. And the problem was they needed money because maybe they lost a job or they needed to be able to pay their bills, but their money is tied up in an account that if you pull it out, it's taxed and you pay a penalty. And to make it worse, they're taking it out at the worst time. You're taking it out after the loss. And to add more salt to the injury, once you get back on your feet, you can't easily put it back. Right. So to me, that access to liquidity, particularly if we're trying to create that passive income, we can't do that in an account that we can't touch until we're in our 60s. We need that money outside. If we want that passive income to pay our bills, we need it outside of an IRA or 401k. And I think a lot of people, a lot of our clients are business owners and investors. And like a business owner, their best use of their money it should be investing it back into their business, not into a mutual fund. So this gives them that liquidity to be able to invest in what they know and create passive income.
Yeah, absolutely. The other feature there is control. And the way that I was thinking about control is the way that Anthony kind of ended it right there is when you hand your money over to somebody, right, typically in traditional accounts, is you have no control over the outcome of what's going to happen there. It's really just based on pure speculation. You're hoping that account is going to go up. The real way to create wealth is quote unquote through investing, and investing, there's a level of due diligence that goes into that. So before you put your money into something, you need to know that there's a very high likelihood. And like Anthony said, is the best place that you can do is invest in what you know in the business or the industry that you're in. That's where you're going to see the most opportunities. Mm-hmm. I think this idea clicks so well with real estate investors or realtors is because they're looking at real estate all day long. And they look at it and they go, dang, man, you know what? That property there is valued 20% under market value. I'll buy that and just flip it real quick. Same thing with business owners. If you've been in that business for a while, you're going to start to see opportunities that others don't, right? So maybe it's an ancillary business that's complementary to your main one, right? Or maybe it's hiring somebody else to go drive another truck for you, add to your fleet, something like that.
And for example, we had a client who they had a pizza franchise. And when '08 happened, like a lot of leases, commercial leases, a lot of companies were going out of business. So they were able, since they had control of their money, they were able to buy equipment for 10 cents on the dollar. And they were also able to expand their business when other people were closing up shop. And I think we're going to see a lot of opportunities here in the next 2 years. You know, we feel that people have a tendency to overreact. When it's good news, people start buying that asset up, and then on where it's too high, and then when there's bad news, they panic and they sell it when it's too low. So we're going to see a lot of panic here, and we're starting to now, which means if you have access to that liquidity, there's going to be some great opportunities. And one thing I like to say, the bigger the opportunity, the smaller the window to take advantage of it. So we need to be able to have access to capital. And when things are not going well, like in '08, the credit markets tightened up. It was hard to get a loan. So, which means if you have access to liquidity, that dollar is going to be able to buy more because other people don't have access to it.
It's beautiful. And actually, that's one of the main reasons why I also want to open up a policy, because of that liquidity factor and the idea of becoming your own banker, where you don't have to necessarily go through this institution with all these approvals, but you have something you've been building that you can tap into for times of opportunity. I had spoken with someone a few weeks back. It was actually about the 2008 crash, and he was speaking on his mom, and she because she was in a tough spot, she ended up selling a lot of her investments during that time. Mm-hmm. And it was like a 15-minute call. It happened. She lost so much money, but it just happened so quickly. It's because it was illiquid, a lot of her investments. And so what this is doing is helping to sidestep a lot of that. And I think that's amazing. Awesome. So that's the setup in terms of that. And in terms of, I guess, like how does it really work? So, there's like this IBC thing, becoming your own banker. You mentioned the book, Nelson, like what exactly is happening? Like how does someone even get started with this sort of thing? It can be very overwhelming for someone that's just getting started with it.
Yeah. And it can be, but it doesn't have to be. Right. And I know a lot of your listeners are business owners, and we call this the cash cycle of business owners, right? They need to store their money somewhere, right? So they're typically going to store it in somewhere where it's safe and liquid. So it's typically going to be a bank. They store the money in there, and they're going to have some expenses in there. They're also going to do some like investments, meaning maybe they're buying equipment, or maybe they need to expand, but they need to reinvest the money into their business. And then the profits of the business, where does that go? It goes back into the bank account. And then they take those dollars and reinvest back into their business. And they're just cycling the money over and over. Now, the downside of that is every time we drain our account, we're breaking the compound interest curve, right? Because meaning we stop earning interest on those dollars. Now, at what point do you want your money to stop compounding? What would you say?
Oh, never. No.
Okay. Good answer, right? Okay. But the system most people are using, we're breaking it every time. And all we're going to do in the simplest terms is just some of that money, instead of saving it at a bank that's safe and liquid, we can store it in a high cash value whole life policy that is not only safe and liquid, it's also going to earn at a much higher rate of return that's going to be tax-free. And typically, depending on what state, that money could be asset protected. And so in the simplest terms, that's all we are really doing.
The downside that Anthony highlighted is, I don't know if you put enough emphasis on that downside. And the reason I am saying this is because what people are doing is the same thing that I was doing, right? Is they put money into a checking or savings account, and then what they do is they take cash out of that account and they liquidate it, right? And that account goes down to zero. John, I think that is the single greatest mistake that people are making in personal finance. Right? And I wasn't aware of this. I was doing this for a really long time, and it wasn't until I came across infinite banking, did my own research, and I realized this is that you don't have to do that. Right? The most efficient thing that you can do with cash or money is you can actually put it up as collateral. And you can choose a whole bunch of different accounts, but the best one to do it out of is going to be a life insurance policy that's designed for cash. And then what you do, here's the kind of the trick here, is you're going to use the loan provisions on that policy. The reason you're going to lose the loan provisions on that policy is because you want to keep your cash sitting in there, earning, growing, and compounding. And then what you're going to do is you're going to borrow against it. And you're going to go borrow against it for all the business expenses, payroll, all that stuff that you typically are going to use it for. And then what we're going to do is we're going to work in some of those investments as well, right? Back into the business, bigger fleet, bigger employee, more employees, whatever it's going to be. But if we can just get on that cycle and stay on that, man, we can accomplish a whole lot of somebody's financial goals in a very short period of time.
Got it. So just to echo back, so you have this whole life policy, not a term, a whole life policy. There's some cash value to it. And through the way that this is designed, you are able to access the cash by taking a loan on that cash value. So it continues to grow. You still have access to it. And then you can then use that money for some of the things that you might need to grow the business, whether that could be acquiring another business, investing in another truck, maybe making a key hire. But it's through the vehicle of a whole life insurance policy with the cash value component to it.
Absolutely.
Yeah. And you know what? There's a lot of misconceptions about life insurance, particularly whole life. And I like when I had my CPA firm, I'd have these life insurance guys come in to try to sell me life insurance. And I'm like, man, I'm not going to have any cash value till 5 or 6 years. I'm not worried about the death benefit. I'm worried about growing my business. Right. But what I like to say is that this ain't your mama's whole life policy. It ain't where it's designed a lot of death benefit and no cash value. It's the exact opposite. We have a low death benefit and a lot of cash value because we have people literally starting their policy and taking their cash out 30 days later. So these are designed to be very liquid because we want you to be able to put that money to work. And if you don't have a place or don't have a job for it, it's got to sit somewhere. So let's sit it inside our policy ready for the next opportunity.
I love that. And I guess I can mention this to everyone as well. Like we had set up my policy about a year ago. Right. And I remember like one of my questions was, and how soon can I access the money? And it was very soon. Like, it was, like you said, 30 days. And, I've, gone through the entire process of going in now, and it's really awesome. Never knew a policy could be designed like this. So.
We didn't either.
Either did Anthony until I showed him.
You beat me to it.
Oh man, and maybe could you also just speak more to, because I have mentioned this strategy to some people, and they're like, oh, we don't, we think that's not really good to do that. We just want to stick with like you mentioned earlier, the low cost, index funds and investing in that. You could probably get a better return doing that, and all these things. And for me, when I first was getting started, those were a lot of the same things that I was saying too. And so
me too.
Could you help coach around that? Because
love to. Because when I first heard about this and I read the book, I was like, this sounds awesome, but I'm more of a researcher, analytical guy. So I went to a lot, and I had a lot. I worked with a lot of typical financial planners. I was like, why doesn't this work? Or tell me why. And my personal one goes, oh, I can get you a much higher rate of return. And so then I went back to the guy who was teaching me, and no, it was not Cameron. He's like, this isn't about a rate of return. This isn't an either or. We're not saying invest in whatever you want to invest in, whether it's your business, whether it's low cost mutual funds, high cost mutual funds, rental properties, whatever. We want you to invest in what you know. All right. This way you can do both. And I had a client who paid his first year's premium, and he was investing. He was a true investor. He was doing his research, analyzing companies, and he's like, you know what? I can earn 10% every year. Why should I put my money in here? And I'm like, why can't you do both? And so what we did is we did the math. I'm like, okay, he was putting in 20 grand a year, I think, or might have been a little more. I don't remember, but every year we ran, okay, if you invested $20,000 and make 10%, pay the IRS, here's what you're going to have. And we kind of ran that all the way until he was 70. Okay. Then we also ran, his policy all the way to 70. And to be honest, his investment account was, I want to say $500,000 more than what he had in the policy. Okay. Again, we're assuming he made 10% every year.
Yep.
Okay. Which there's going to be some bad years, but that's what he was looking at. I'd rather have $500,000 more, and so would I. Okay. But we can do both. So then what we did is, okay, what if we borrow against your policy and then invest? And I would say in the first year or two, he was ahead, right? Because there is a little slower start, right? When we start a policy, you put in $1, you can't turn around and take out the same dollar. So he was able to buy more in his investment account. But by year 3, we were able to buy the same amount of investments that he was. And by year 10, because of compounding, we were able to buy not $20,000 of investments. Because of compound growth, we could buy $30,000 of investments. And then I want to say by year, don't quote me on this, but I think by year 20, he was able to buy 40,000 of investments. Wow. So the problem with, just like what Cameron was saying, that just paying cash is one of the worst things to do because we're breaking that compound interest curve. But because we're borrowing against a policy, we're not taking it out. That money is continuing to grow. And at the bottom line, when we compare doing IBC to compare to an investment account, he had $1 million more.
Wow.
For doing the exact same thing. And that's why sometimes, we're say that this is like using a rewards credit card, right? You're going to buy something anyways, but by using a rewards credit card, you get some extra benefits, miles or cash back. We're just doing the same thing for our investments, but instead of using a rewards credit card, we're using your policy. And instead of getting miles, you're going to get more money. And really, did we even mention death benefit? We even talked about death benefit. Not to mention, he didn't need term insurance, right? Because he had permanent insurance. And instead of that death benefit expiring when he's 65 or 70, what most financial gurus will tell you to do, he had about $2 million. I don't know. He had to have more. I don't remember. I should get these numbers. But he had permanent death benefit.
Wow.
And a lot of people don't realize how important that is. But, I mean, when you're in your 20s or 30s or 40s, big deal. But when you're in your 80s, like Cameron's talking about, we start thinking about our legacy. And that can help us, whether that legacy is for the kids or maybe it's for a charity, or we can do a lot of good with this. So when we say whole life, I mean, that kind of unfortunately brings some additional myths to it, but we've done the math. And in fact, we have a YouTube, a YouTube video where we walk you through the math. And, I will send you a link to that if you wouldn't mind putting the show notes.
Oh yeah.
We want people to learn. Don't take our word for it. Learn about it. Let's do the math. And we've done the math, and running whatever your investment is, whether it's your business, a rental property, these low cost mutual funds, you'll have more money at the end of the day using IBC than just using cash.
And I think that was the key point for me too. It's not you're just using it as an investment and just keep it there in the policy and it's 4 or 5% a year.
No.
But it's what you do after that. It's you got that plus you take a loan against the policy, and then you access that capital, which then can be deployed back into the business, which then can be deployed into real estate or whatever you want. So it's not just that one thing, right? It's not just the vehicle of whole life insurance. It's like what you're doing. That's a stepping stone to doing other things as well, which I think is beautiful. I think that was like the missing point for me in the beginning when I was like, I don't get it. Wow.
Absolutely. When you talk to somebody, right, is when somebody's bringing that kind of objection up, is they're chasing returns, and they're chasing returns because they've probably been a good student of finance, the financial industry, and that's what everybody's taught to do. But when you actually sit down and you talk to somebody about what they're trying to accomplish or what they really want to accomplish at the end of the day, it always comes down to income. And if you're chasing returns, you're kicking that income stream down the road till 59 and a half, 60 years old. And we're having completely different conversations when you're talking about IBC. It's, hey, I'm going to put my money here where I've got control and access to it. And now how am I going to go create some sort of income stream for me? So you're either chasing returns or you're creating income, one or the other.
Love it. And maybe what we can talk about now is just like what strategies can people do? Like, let's say someone's in the trades, they decide to open up a policy. And I know like at different time points, like they can do different things. But like what are some strategies that someone could use a policy for to begin to build towards that financial freedom that they're looking for?
I'll jump in. I'll give you a story, actually. Give you a second. Is that this is going a little ways back. What a client, he was a plumber, and at the time, he had a great plumbing company, very successful business. But he reached out to me, and he's like, Cam, I want to sit down and want to talk about, some financial options for me, this and that. And he comes in, and essentially he says, hey, what's a great stock tip? Right. And I'm like, wait a second, what's going on? That's not what we're doing here. Right. I'm like, no, like, let's talk about your business. Let's talk about opportunities that we can find in that. And don't hold me to these numbers. Right. But what it ended up coming down to, right, is the guy had, maybe 100,000 that he was looking to put somewhere, do something with. And so we started talking, and really what we came down to was, hey, let's go buy a truck, maybe 2 more trucks. And let's go hire a couple guys to drive those trucks, right? And to go put that money in service. And what we came up with is that guy was to put out $100,000 in the form of buying equipment and vehicles and putting somebody out there. That would create, like $200,000 of ongoing revenue every year. And so completely different conversation, but a great example of, again, that's kind of what we do is we're going to put some guardrails up, and we're going to say, hey, listen, let's focus. Let's look at your business and invest in what you know, right? Which is going to be the business that you built from day one.
I'll add another story. We met with a client, and one thing we always first thing we ask people are, what are your goals? Right? Because kind of we value, if you're going to work with us, we need to bring value to you. And we define that is, can we help you achieve your goals faster and with more certainty? And one of the goals of this client was, I would love it if my wife didn't have to work anymore. So he had a cabin that he had used kind of as a vacation home, and he started to rent that out on Airbnb, and that started being profitable. And he's like, you know what? I want to buy some more cabins. But a lot of his money was stuck in his 401k. He actually took it out. He paid the taxes, right? But then he bought these rental properties. Those rental properties create tax deductions that he was able to use to offset the income from the 401k. And I don't want to get on a tangent on taxes, but the bottom line is now that he had control of his money, he bought a total of 4 more properties. And within 6 to 7 months, not only was he profitable, but he was able to say, honey, he was able to say to his wife, you know what, you don't have to work anymore. And, so she stopped working, and maybe at first glance, cash flow was neutral, right? Because they was able to replace her income. Okay. But it's not all about money. Now she's there. They have a better quality of life. She's not as stressed. She can be more active with the kids. And what had happened, she got active in their short-term rental business and ended up growing that even more. So what they've done by having control of their money, not only are they creating more income, but they're having a better lifestyle. And really, I think that's what it's all about. In our view, money is just a tool. Mm-hmm. And it could be used as a weapon or as a tool. And if we use it well, it can allow us to create the lifestyle that we want.
Just living life on your own terms. And I mean, that's a really cool story, just because it's, people can feel trapped. It doesn't feel like there's a way out, and to be able to use, insight, information, knowledge, and deploy your capital effectively to really build out of a situation that is causing, a mom to be more distant from her kids than that she really wants it to be. And so it's really like this is just like all what we're talking about is a vehicle for really building that life that people want.
Mm-hmm. Couldn't agree more.
And I think one other key thing too, I think to just point out is you mentioned earlier that there's like a startup phase when it comes to these types of policies. Mm-hmm. I remember when we first talked about it, there was like this 5-year period, and I feel like that can be like the most difficult chasm for someone to cross. But after they cross that chasm, it's a lot more smooth. Could you speak to that and some of the things that would happen if someone started a policy, let's say today?
Yeah, there's lots of designs when you're designing a policy. I'm going to go to probably the most traditional design is where somebody's just maybe contributing on a monthly basis and kind of monthly annual contributions without anything one-off, no big lump sums, anything like that. So if somebody's doing that, what you need to understand is when you start an insurance policy, there is going to be a cost of insurance, right? There's no way to get around that. That is part of what we're doing here. That's part of the product. We need it there, to be honest, to kind of have that umbrella of tax-free growth and distributions on the back end. And so we have that part of it. And so when you're looking at a properly designed whole life or IBC policy, there is going to be costs. And usually that cost is going to be isolated to probably the first 2 years. Mm-hmm. And so when someone's putting together a policy, when I'm sitting across from somebody and we're looking at an illustration, is I'm going to point out exactly what that cost is. And typically the way I'll do it, John, is I'll say, hey, here's our cost in year 1, right? Here's how much money goes in. Here's how much money we have access to. Here's our cost. I'll go right down the next year. Here's how much money we put in. Here's how much money we have available. Here's our cost. And what somebody sees pretty quickly is the cost actually diminishes, or it gets lower rather quickly. And by year 3, certainly by year 4, the way that I communicate is there's really no cost. You put $1 in that policy, you got 100% of what you're putting in there is showing up as cash value. So that slow start is usually isolated to the first 2 years. And this is what I tell everybody. I will stand up here and talk till I'm blue in the face all day long about how great IBC is, but I'm also going to point out kind of that slow start, what I would say is probably the downside to it. And if somebody can't get past that downside, right, as small as we try to get it, then infinite banking's not for them. And we'll lay that out to them, right? And so if we're looking at planning, 5, 10, 15 years down the road, infinite banking is going to be a great fit. But if somebody's looking at, the best returns in year 1, year 2, then we're not a good fit for them.
I related to kind of starting a business.
Yeah.
Right. I'm sure a lot of your listeners are starting a business, and you know what? I guarantee you that they didn't make all their money back in the first year or 2, maybe even year 5. It might have taken a while to build it up. And so if you're short-term focused, IBC is not for you.
Yeah.
And kind of what I think IBC is for everybody, but not everybody's for IBC. Right? You have to have, that's right. Okay. That's a good one.
Finally said something.
Right.
Yeah.
But
45 minutes in, you gave us a nugget. Good job, man.
Thanks. But what just like Cameron, there's pros and cons to doing everything, and infinite banking is no exception. And we're not just here we're going to tell you the great things about IBC, but we're also going to tell you the things that maybe aren't so great, because we want people to understand that going in. Last thing we want is a client to come, after they start a policy, hey, I didn't know about this, or we want to be very transparent and be open. And if IBC is for you, we want you to do it. And if it's not for you, we don't want you to do it. So we're going to explain the pros and the cons.
And I could also be a testament to that. You guys both remember when I when I first reached out, I watched basically all the videos on your YouTube channel. I came with a gajillion questions, and Cameron was so very patient with me. I had a lot of questions, and I really experienced, like, you're not just saying, like, I experienced your educational approach and taking the time to walk me through how it works, my concerns. And I think that was huge, because it was something I didn't understand. And then by the time we were done speaking about it, I had a good framework of how it all worked together. And so I just want to say, like, thank you guys for being who you are and how you educate. I think it's something that is much needed, and it's something that you guys are providing. So thank you.
Oh,
yeah. Thanks, John. Yeah. Appreciate that.
Yeah. I was like Cameron said, he could talk till he's blue in the face. And yes, he can. I've seen it, and it's not a good look on him, but we're very passionate about this, and we love teaching it. I'm a recovering CPA. I'm not a salesman, but I've done the math. I've done the research in here. And I mean, this is a great strategy for people who are open to it.
I love it. And just before you transition, because I did want to talk, you talked about psychology and how someone's money psychology and how they think really does play a big role in having this be successful for them, and also just being an investor. But before we go into that, just want to tie the bow on the IBC concept. Is there anything else you want to make sure to cover in terms of, like, how it works, or maybe some concerns people typically have, or anything from that?
Yeah, I do want to add. I would add that for better or worse is when I approached infinite banking, is I didn't listen to a lot of the noise. Right. And so what I would say is that if somebody's going to kind of take a look at infinite banking, is be really cognizant of fact versus opinion, and who you're talking to, or where you're doing your research online, or whatever it is because if you separate the opinions and kind of kick those to the side, because everybody's got one of those, and you focus solely on the facts and do your own research on how the policy actually works, great tool. But there is a lot of noise out there for somebody that's going to get started. Second thing I'd add is, even for us, when we're talking to somebody and we're communicating how infinite banking works, is there's kind of two parts to it. There's like the seen part, where you can show somebody an illustration, and then there's the unseen part, right? The intangibles of the income and everything else we've created outside of that. And to model that is really difficult, because some people go really fast, some people go slow, right? Based upon kind of their skill set and where they are. And so when you look at an illustration, you're looking at like worst case scenario, to be honest, right? Yeah. And that's one thing that's often overlooked is people look at an illustration and, oh, well, that's okay, right? Well, listen, you're missing the whole other half of what we could be doing with this. And that's why it's important, again, to have a mentor, have somebody that can point out some ideas and identify your skill set and say, hey, I think this might be a really good fit for you. Let's look into these strategies of creating income.
and one resource for that, again, we want people to get educated, read Becoming Your Own Banker, do your own research. And we've compiled some in our online course. And when you talk about the seen and the unseen, I'll tell you my favorite video series is we compare how much income you put into a policy, how much income somebody could get in retirement. But now that might look good at first glance, but compared to what? Right? If something's good or bad, you can't truly say that unless you're comparing it to something else. Right? And so a lot of people will compare a whole life policy with an investment account, which they're very two different vehicles. I don't think it's a fair comparison, and I can see why people do, because it's typically the same dollar that they're not, is where are they going to put it? Well, in one of the videos, we did the math on what rate of return would you have to have every year to produce the same cash flow in retirement from the policy. And I'm not going to give that number away, but they're going to have to watch the video. But that makes it sound to me a good place to store the money. And that's like what Cameron's seen is the scene. This is a policy, or this is if you do nothing. But then we expand it. Well, what if we leverage against that and we buy an asset and we use that cash flow to pay the policy loan? And one asset we typically use a lot is real estate. And like we even said, well, what if we bought a rental property through the policy and use that cash flow to pay the policy back? And when the policy is paid back, now we have a cash flowing asset. And like Cameron said, we didn't take the money from our policy. We took it against our policy. So we have that same cash value that we would have had. But now, not only do we have a cash flowing asset, but there's equity inside that asset as well. And that's the unseen. So when people are bad mouthing whole life or IBC, they're talking about the seen. But I guarantee you, if we add the unseen, this will beat any strategy.
And one mistake I made when I was first diving into it was paying too much attention to, people commenting on Instagram and on Facebook and on YouTube videos. And I realized that these are just a lot of bystanders and a lot of haters who really don't, have not really built any significant wealth. And so I'd say, like, if anyone's really looking into things, like really be careful who you listen to, right? And there's some people who are really charismatic, but they don't really know what's really going on. So really be careful the mentors that you select and the sources that you read, because it can take you off track. And you could be talking to someone who's very knowledgeable, then you read a few comments on how they know better, and then you just completely thrown off track. So be careful.
I think you made a very good point. Is a lot of time these people making these comments are broke as a joke.
Yeah.
Right. They don't have that wealth. I mean, really, would they be sitting on is a wealthy person be sitting on YouTube making, nasty comments?
No.
All we're doing, if you look at, there's a great article that was produced a couple of years ago talking about how the wealthy are not paying taxes. And they talked about Elon Musk, where he has this stock that he's not, if he were to sell it and use the money, he'd pay taxes. But if he borrows against it, he takes that money tax free. And that, in essence, what we're doing. I mean, we just don't have the stock. We're just a different asset we're using is a whole life policy.
And I looked real quick. So just for the stocks too, like you can only borrow, I think like it's up to 40 to 50%, right? You can't get the full value of that stock too. And so I think, someone could try to do, I guess a line of credit. I don't know the exact terminology, but the line of credit on the stock, but you're not going to get the full amount. But with a policy, I think you can get a lot more out of it than just the whatever percent.
Well, and that's a great point. Why will literally you can borrow 100%. We wouldn't recommend it, but you could borrow 100% of your cash value. But then if you had that same amount of money in an investment account, they're only loaning you 40. Like, why is that? I mean, that means there's more risk. That thing could lose. I mean, and so borrowing against maybe a 401k loan, people will do, or against your stocks or a HELOC, all of those are great, and it's very similar to IBC. The difference is what asset are we borrowing against? And because of the guarantees and of of your policy, and we're talking a product that's literally been around over 200 years, pretty good track record, right? And that can make a great foundation for you to borrow against, and you have that foundation. So when there is a difficulty or a crash or a correction, you're going to be in a position to take advantage of it. You're not going to get that phone call from your broker. You got a margin call. So now not only did your stocks go down, but because of margin call, you have to sell it at the lowest point, which is just making those returns even worse.
John, that article that Anthony mentioned is from ProRepublica.
Yeah.
And what it talks about is it highlights Elon Musk. It talks about Bezos. It talks about all these very wealthy individuals that have built a ton of equity inside businesses or real estate holdings. And the way that they're tapping into that is through borrowing. And they work on lines of credit, essentially, right? And so that same idea is applicable just on a personal or much smaller level, which is what we're doing here. So I have that article. I'm happy to send it to you and put it in the show notes.
That'd be great. Yeah, I'd love to have to the show notes.
Yeah, absolutely.
Perfect. Awesome. So I guess with that, and I think we're coming up on the hour. I'd love to, just as we're pushing to the close, maybe just talk some money psychology, and it could be around IBC, it could just be in general. Like I've said in previous shows how, I mean, really it's a mindset game, right? It's like keeping yourself in check, and when to buy, when to sell. Also, a lot of childhood beliefs can like be impacting how we make money. It can cap us at a certain level.
Yeah.
Can you speak to a few of those, like maybe beliefs that you guys had to work through yourselves or helped clients work through in order to, break through to that next level? Because it really is like a law of the lid of our own mindset, which blocks us.
Yeah. A great book that I really got a lot out of was called
Cat in the Hat.
Oh yeah, that was a good one.
Green eggs and ham.
That was a good one. Was this Secrets of the Millionaire Mind. And what he talked about is, just like you mentioned, mentally we have this comfort level of where our income could be, and we start making more money than that, we're uncomfortable. And we end up making decisions to kind of bring us down. And that hit home to me because I remember when I was right out of college, I didn't grow up with a lot of money. So when I finally started making some, it felt a little weird. And so you know what I did? I went out and bought a car. Okay, so now my income is, or my net income is kind of, I felt more comfortable. And it took me a while to kind of be able to break that mindset. And how do we get through that? That's where it is, by having a mentor or a group of people with a similar mindset. And those are going to be the people that will help you grow. We always have, and a lot of times it's family members, but we have these distractors or people who are very negative and they don't understand, or they maybe indirectly, maybe they don't want you to succeed. But we got to make sure that we're filling our mind with truth and things that are going to help us move forward and not help us go backwards.
But John, what I would say is the first thought that came to my mind is I grew up in North Idaho, Post Falls, tiny little town. We didn't have any money, right? Nobody in town had any money, right? So the wealthiest, quote unquote, wealthiest guy that I knew was a physical therapist, right? And he is a family friend. Yeah. And we'd drive by his building, right? He had his name on the building, every day when I was a little kid. He was right there on Main Street. And it was that vision of success is what drove me. And that's why I ended up in Las Vegas. I didn't put that in my story, but my original plan, right, when I was going to school was to become a physical therapist because that was the most successful person that I knew. Mm-hmm. And so that's what brought me to Las Vegas and all that stuff. And then, right, so getting out of that was probably one of the best things that ever happened to me, was making my world a little bit bigger, getting exposed to different things, and just getting out of that small box that you're in and making it bigger and seeing opportunities. And then Anthony said the word distractors. Man, right? Some of the most successful people that you're going to ever meet don't get distracted. They don't get distracted by what people say, and they don't get distracted by shiny coins, right? Anthony's heard me say this 100 times, but a lot of times, right, there's going to be something that is the latest and greatest thing that's going to come up, and it's going to last for 6 months, maybe a year, 2 years, and then it's going to fade away, right? And then it's going to be the next thing. The guy that's going to be successful is the one that kept his head down, right? Kept churning out, working on that business. Nothing happens overnight. But then one day, right, it's going to take off. Everything's going to fall into place, and then he's going to go, and everybody's going to be like, oh, man, look, that guy made it. He just spent 10 years, right, just toiling in the background, working his butt off.
Overnight success, quote unquote.
Yeah.
Exactly. So as far as distractions and just having a mindset, man, find a niche, find something, get really, really good at it, and don't let anything distract you. Don't get distracted by shiny coins.
Love it. And before we close out, I know you guys mentioned you have a course as well. Could you speak to like what's in the platform and how people can get access to it? Because it sounds like it's a very powerful educational resource for folks.
Yeah. Man, thanks for that introduction. That's what it is. When you get into the courses, you're going to see that's not salesy by any means whatsoever. It's a bunch of videos. Anthony's video that he referenced earlier that he said was his favorite, it's in there. The reason that it's his favorite is when you guys see it is he's the only one in it. So he did it on his own. So I'm not in there.
That's one reason.
Yeah, exactly. But we're going to give you guys, right, John, as a thank you for having us on, is we're going to give the listeners free access to that course. Typically, we're charging $500 for access to get in there and kind of look around and get educated on this process. But we're happy to give it to your listeners as just kind of a thank you, right, for sticking with us for an hour. Is if they go to infinitewealthconsultants.com/Pollyanna, that's going to take them to a landing page, right? We will ask for an email if you guys want to give that to us, then we'll give you access. And once you get in the course, all education-based, a whole bunch of videos that's going to give you a good overview, a good foundation of infinite banking. And then, like Anthony said, is we have a bunch of videos that's going to look and kind of expand on the unseen, right? Hey, what if we go use this for real estate? What if we go use this for, investing back in our business? And we'll do some of those numbers for you.
What's also going to be in there are ways to create passive income.
Yeah.
Whether it's rental properties or buying ATM machines, flipping raw land, short-term rentals, a lot of things maybe people had never even heard of, but we're going to have some introductions in there. And we're in the process of redesigning our course, which we'll be adding a lot more to it. So whoever's already in the course will be grandfathered into the new one. So check it out. We're not selling. We're not going to call you. Watch some of those videos. There's a section called the Fast Track, which will give you a good foundation of why we use life insurance and how infinite banking works. And if that's interesting to you, then there'll be a link in there to get on a call with us. 15 to 30 minutes, talk about your goals, kind of see if we're a good fit, and then we could talk about the appropriate next step.
Guys, thank you. That's so generous of you. And again, for anyone who's listening, like, get in there. It's free information. It's typically $500 to get in. And you always get an advantage by learning and being educated with correct principles. And so there's really not a downside to you aside from you spending the time. But if it's, this sounds like a vehicle that you could use to, springboard yourself towards further in the future. Like as for me, like I think this would be something for you to check out. So with that, any parting words, guys, as we wrap things up, any advice or thoughts or things as we close?
I would just say that figure out your goals. I mean, and if they are financial freedom, right? Building passive income more than your monthly expenses, are you putting your money that is going to help you achieve those goals. And that's one of the biggest things we see. People want financial freedom, but they're not putting their dollars in places that are going to help them achieve it. And don't badmouth Cat in the Hat. Okay. Great book.
John, I just wrap it up there and say, thanks, man. Really appreciate you giving us the opportunity to come on. And
this is a blast.
Yeah, absolutely. Thank you.
Awesome. Thanks, guys. And thank you, everyone, for watching. We'll check you out, or we'll catch you on the next episode. All right. Take care, everyone.
Welcome to the HVAC Financial Freedom Podcast, a show where we talk about HVAC business ownership and financial freedom by sharing stories and advice of experts who can help you get there. Now your host, John Victoria.